All right, we got a few more examples here for analyzing a transaction. So this is part 3 in a 3-part series. If you are wondering why we are starting with example 6, probably want to go back to the first of these 3 videos. Watch those ones because it'll make much more sense when we talk about all of these examples because they all kind of run together. All right, moving on to example 6 here. Walnut Creek Inc. signs a contract with a sign designer, Joe Intelligence, to design and install a marquee sign on the front of their venue. They have agreed to the cost being $6,540. No sign has been received yet. So has there been an exchange? Well, there's been an exchange of a promise that they, Joe Intelligence, will produce and install a sign on our property, and we promise to pay them. But has there been an exchange? No. So if there's no exchange and it's just simply just a promise, what do we know? We know that we don't have a transaction, so we won't book anything. So a promise to perform service related to a contract is what's happened. No accounts are affected, which also means no categories or components are affected, which means this is not really a transaction that we're concerned with, right? Now, should we know about it? Absolutely. We do need to know about it. So we should, as the accounting department, have a copy of the contract. But we personally are not going to enter it into the books because nothing has been exchanged. Now, once the sign has been delivered and installed, then we have a transaction, which means that we are exchanging a sign for a promise to pay or cash, however we're going to settle that bill. Then an exchange has occurred. So this is just purely a promise, but nothing's really exchanged. So because nothing's exchanged, we don't have any journal entries, we don't have any transactions, we don't need to do anything with this. So we are going to move on to example 7, okay? Oh, here, Walnut Creek Inc. receives their marquee sign and pays $3,000 in cash and promises to pay $3,540 within 30 days. Ooh, so we've got a couple of things happening here. This is a compounded transaction, which means it has more than 2 elements. It actually has 3 elements. So we're going to help you walk you through those 3 elements. Can a transaction have 3 elements? Absolutely, there can be 3 elements. There can be hundreds of elements. We're going to keep it simple here. So we've got 3 elements here. So what happened? Well, Walnut Creek Inc. we received a marquee sign in the installation valued at $6,540, okay? And what did we give up? Well, we gave up cash and we gave up a promise to pay. So we exchanged cash and a promise to pay for this marquee sign. So that's kind of what happens, exchange of a sign for cash and a promise to pay. So what accounts are affected? Well, we know that we're receiving a sign. So sign, we might use, we can use that as an account name. So we're receiving a sign and then we're giving up cash and a promise to pay. Well, what do we call that promise to pay based on some of our other examples? Accounts payable, right? So cash and accounts payable in exchange for the sign. All right, so cash decreases, the sign will increase, and the accounts payable will also increase. All right, so moving on to step 3, what categories are affected? So what is cash? Is it an asset, liabilities, owner's equity, expense, dividend, or revenue? Well, we said that cash is always an asset, so asset here, so cash is an asset. What about the signage? Well, the signage, can it produce yield future benefits? Absolutely. So then that would be an asset. So we have cash as an asset, the sign as an asset, and then we have one more, the accounts payable. So the accounts payable, what is it? A liability. So it's a liability, so we have 2 assets and a liability. That's what we're going to be concerned with here. So cash is an asset, the signage is also an asset, and the accounts payable is a liability. All right, step number 4 here, how the categories are affected. Well, they are affected in that cash, is it going to go up or down? It's going to go down, right? Out of our pockets, down. What about the signage? that's going to go up, right? We're receiving something of value, more value, so increase. What about the accounts payable? We're going to owe more, so that's going to go up as well. So the asset's going to decrease by $3,000, that's the cash. The asset's going to increase by $6,540, that's the sign. And then the accounts payable or the liability is going to decrease by $3,540. So how does this look like on the accounting equation? Well, let's start with the first asset, and that's cash. So cash is going to decrease by $3,000. So cash negative $3,000. What about the signage? Well, the signage increased. It increased by how much? $6,540. So that's an asset that's going to go under the asset column. So the sign is going to be plus $6,540. Now what's left? Well, we have an accounts payable. It's a liability, so it's going to go in the liability section. So the liability is going to go up or down. It's going to go up, okay? So it's going to go up. So the liability is going to go up by $3,540. Now, a couple of things here as you look at this. Can we have a plus and minus in the same category? Yes, we can. We can see that here. Plus sign $6,540 minus $3,000 in cash. Can we have more than 2 entries? Absolutely. We have 3 entries here. We've got cash, sign, and accounts payable. Notice here, does my accounting equation balance? Well, 0 plus 0 plus, it looks like 6,540 minus 3,000 is 3,540. So 3,540 equals 3,540 plus 0. Our equation balances. So this is an appropriate transaction analysis that we've done. Okay, so again, we can do that as long as the math adds up. And in this case, the math does add up. All right, any questions? Well, it doesn't matter because we're on video, so I can't answer them anyway. So let's go ahead and move on to example 8 here. Walnut Creek Inc. Just like tweet them to me or like email them to me, whatever. Walmart Creek Inc. received supplies costing $825 on account. So this is a new thing here. When you see the word on account, that means account. And it could be one of 2 answers, accounts payable or receivable. So when you hear on account, that means it's going to use credit. But the question is it accounts payable or receivable? Sometimes when I teach this, I'll say on account means accounts receivable. And then we go through the semester and a student goes, why is it receivable or payable when you said it was a receivable? Well, it's both. So on account means accounts, and then it could be payable or receivable depending on the context of the question. So in this case, Walnut Creek Inc. receives supplies costing $825 on accounts. So the question is this accounts payable or receivable? Well, we received supplies of $825, which means we would owe the vendor $825. Therefore, we have to pay them. So it would be an accounts payable. So on account means that you bought it on credit or you sold it to a customer on credit. The question is it going to be a payable and receivable? And that's what you kind of have to figure out. All right, so what happened here? We exchanged a promise to pay, accounts payable, for $825 worth of supplies. So we exchanged a promise to pay for supplies. What accounts are affected? Well, we gave up a promise to pay in the form of accounts payable, and we received supplies. So supplies increase, accounts payable increases as well because now we owe them more. What categories? Well, supply. What type of account is it? Is it an asset, liability, owner's equity, expense, revenue, or dividend? It is an asset. So supplies are an asset until we actually use them. So for instance, in my office here, I have a whole bunch of notepads. That would be a supply because I haven't used them. The notepads are just sitting behind the camera on a shelf and I'm not doing anything with it. So that is a supply. Does it provide me future benefits? Absolutely, it does. I can use it to write notes and blah, blah, blah. So supplies is an asset. What about accounts payable? Accounts payable is a liability. So what categories are affected? Asset increases, liability also increases as well. All right, how are the categories are affected? Well, the asset's going to increase by 825, which also means the liability is going to increase by 825 as well. So if we look at our accounting equation, we know that we're going to deal with the asset column and the liabilities, which means we don't need the rest of them. The asset's going to go up by 825, but then the liability is also going to go up by 825. Which accounts are affected? Supplies is going to go up by 825, and the liability, accounts payable, is going to go up by 825 as well. So hope you're getting an understanding of this, and I can tell you as someone who's studied this for a very long time, there's no magic rhyme or reason that you get this. It's about repetition. So accounting is all about doing, and if you're not doing, you're not learning, and if you're not learning, you're not actually knowing this material. So you're gonna have to do it, and you're gonna have to do it over and over again. You're gonna make mistakes, and that's okay. So that's why we have 8 examples, because we want to do it more and more to help you understand how it all works. So let me give you a summary chart here. If we look at the 3 videos that we talked about this example about analyzing transactions, this is the result of all of those transactions. What you'll notice here is we had a beginning balance of 0, and then the parentheses number, that's the transaction, that's the example number that it corresponds to. So example 1, we had $40,000 cash and we gave up $40,000 in common stock. So that was the transaction in which we exchanged cash for common stock or ownership in our company. Transaction 2, we have $650 negative cash and $650 logo. It looks like we paid $650 to get a logo. And so we can go through all of this, but you notice we can add them all up together. And at the very bottom, we now have ending balances. So we could say that as of this point, as of the end of example 8, we've got $40,425 in cash. We have $825 in supplies. Our equipment is worth $11,850. We have a logo that's worth $650. We have a sign that's worth $6,540. What we owe to vendors is going to be $10,290. What we owe to the bank is $10,000, and we have $40,000 in common stock. So once we've analyzed it, we then kind of post it to a chart like this, which can be summarized, and then we can get a greater picture of what's going on. And this also gives us our ending balances for all of these accounts. So that's what we're trying to do, is solving these transactions. I hope over the past 8 examples, you have a better understanding of what we're trying to do. As we go forward, we're going to help you a little bit more understand that journal entry. How do we do journal entries, which is the mechanism in which we input data into the accounting system so that we can create those summary reports to give to management so that they can make decisions. And in our case, it's not management, but it's external users so that they can make decisions based on the financial data that we've collected. So hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, it is Patrick. Don't forget to press the like button and share this video with someone who could get a lot of use from watching this lesson, like maybe a classmate or maybe a friend or maybe just a parent, just because you wanted to share this video because you're very excited about what you saw. Share it with someone. And if you want to help us grow and help us make sure that we put the very best in accounting topics out on YouTube, make sure you press the subscribe button and turn on that notification bell. That way you're alerted every time we post videos to this channel. Now, I do this with every one of my classes at the end of class. What did you learn from this lesson? Put that in the comment section below, and I'll respond to you on what you got out of this video. So hope you enjoyed this video, and we will see you in the next lesson.